Peter, why do you hate them so much?
Well, I think it's important to separate how we think monetary policy works. There are three channels. There's the exchange rate channel. You can influence the exchange rate. There's credit. We can grow credit. Or there's the wealth effect. We can make people richer. And negative rates aren't a cure-all. I think if Larry's point is no matter what ails you, take negative rates, it'll make you feel better, I disagree strongly with him. I kind of get it on the exchange rate. If you're a little country like Switzerland or Sweden or Denmark and you're trying to avoid your currency appreciating, you don't have a big, deep capital market, you really just have the short end of your yield curve, you try to put negative rates through to avoid a capital inflow. You can probably avoid a further appreciation. You can't weaken your currency much. But let's be clear, negative rates for the FX rate is about a race to the bottom of competitive devaluation. The International Monetary Fund was established to try to prevent us from doing that again, what we did in the 1920s and 30s that was such a disaster. So if you think every country can devalue their currency with negative rates, think again. You can't get there from here. It's only working because the U.S. still has a pretty positive yield curve, and some other places are trying it, and it gives them a little negative. So maybe it works for little countries. I don't see it working for big countries on the exchange rate channel.
And to your point, we actually have a chart that shows what's happened to countries' currencies that went negative, and they all dropped. Basically, the de facto currency war situation.
It went the wrong way.
What about the credit channel? I mean, so theoretically, just make it cheaper to borrow. You get more people to borrow and lend. Does that work at all?
That's the trick. Borrow, yes. Lend, no. So macroeconomists, brilliant ones like Larry, tend to think about the demand side of credit. And if we lower interest rates, people want to borrow more. How do you feel about lending more when the spread you're earning is compressing? So that's why European bank stocks have gotten crushed. That's why Japanese financials were hurting so much. It's not about the level of rates. It's about the shape of the yield curve.
Why does going negative on short end imply net interest margin compression?
Well, first, you're dragging down the long end. And now the question is, can the commercial bank pass it along in negative deposit rates? Central banks' deposits are a closed system. People talk about if the central bank puts in negative rates, people will take their money away from the central bank. No. The Fed decides how big its balance sheet is. If you're J.P. Morgan and you take your money out of the Fed, where do you put it? You put it in some other bank. It's a closed system. But commercial banks, if they put through a negative deposit rate, people are going to take their money and put it somewhere else. So the commercial banks are unlikely to be able to pass it along, in which case you just haircut the yield curve. But let me tell you a story. Think about this. It's 1992. The U.S. economy has a very slow recovery. And I want to assure you, Alan Greenspan went to bed every night saying, "Thank you, Lord. Thank you for the steep yield curve that is helping us recapitalize the American banking system." 10 years later, in 2002, Alan Greenspan went to bed every night and he said, "Why, Lord? Why me? Why are you giving me this conundrum of low long-term interest rates? Don't you know it makes us harder to stimulate credit?" But in 2012, the central bankers all lost their minds and they celebrate every time the yield curve flattens because they're only looking at the demand side of credit, not the supply side. And so the credit channel is one that negative rates just isn't really going to work.
But it's not like banks were killing it with their net interest margins before that, right? So in theory, if demand does pick up because rates are negative, like Larry Summers was hypothesizing there, can you make up for it?
No, if my net interest margin is narrower, I'm getting less reward for lending. And so my incentive, if I pass along the deposit rate and it's negative, my balance sheet shrinks. I can't lend.
Why the seeming zeal, then, on the part of central bankers to experiment with negative rates? I mean, you make a lot of sound arguments. Markets so far don't seem to be particularly enthused. They don't seem to be working particularly well in terms of generating inflation. On the other hand, some of the other tools, like QE, at least you had a good market reaction to that. Why do you think they're getting so interested in them these days?
Well, I think they don't want to admit they're running out of ammunition. And it's become an article of faith that in order to have credibility, they've got to say things that don't have any credibility. I think they've really lost their heads here. They really want to present the face that they're still in charge. The last one is the wealth effect. And I want you to think about this. The idea is if we put through a negative interest rate and we pass it through to consumers, they'll stop saving and spend money. This is the opposite of the wealth effect. we're going to get people to spend more because we're going to make them poorer by taxing their savings in the bank.